Today, we're going to be revealing the strategy that investors are using to 5 or 10x their capital. Let's hop right in. So first, we're going to be going over what Uniswap actually is and what a decentralized exchange is and how you can trade one asset for another. The difference between the decentralized exchange as opposed to Binance or Coinbase or something like that is that you're actually trading directly from your cold wallet. You don't have to go through and touch any sort of authority at all. So for example, if you go ahead and execute an Ethereum to USDC trade, it's going to go ahead and execute that directly through your cold wallet. You don't have to go through Coinbase or anything centralized. And as soon as we confirm a transaction and go ahead and hit swap, it will automatically be executed, and this is done through automated market makers. These are considered automated market makers because there's a liquidity pool or smart contract that always matches the other end of the trade. Now, as an investor, we can of course use Uniswap to trade. We can trade Ethereum for USDC or USD to Ethereum, etc. And of course, there's a ton of other assets. You can just scroll through here and see them all. But also, as a smart investor, we can go even further and start to open up concentrated liquidity pools. So for example, right here, I can go on DeFi Llama and see all the pools that are on Uniswap V2 exchange. And then you can just take a look and look at all these. So first, I want to dive into the strategy that we here use at Builder Wealth in Uniswap V3. So in Uniswap V3, of course, you can pair two assets together. So here, for example, Ethereum, and then you can just do USDC as an example, and then you select your fee tier, of course. And then now in Uniswap V3, they have something new where you can select your range. Well, it's not exactly new. It's been around for 3 years, but in Uniswap V3, they have added it. So here at Builder Wealth, we have been using concentrated liquidity for about the past 2 years. So basically, this range right here is the range in which your liquidity is going to be used. So you can set it on how active you want to be in a position. So for example, if I'm going to set low price to 2,000, and then if we set the high price to 3,000, let's just say, for example, I'm going to have to be way less active as if I were to set the low price to, let's just say, 22.50 to 27.50, like this. And when I say active, we mean checking in our position, rebalancing our pools, and checking our investments every single day. Because basically, as soon as you go out of this range right here, you stop earning fees. And once it goes back in the range, you start earning fees again. So you might have to rebalance your position. And first, to dive deeper into the strategy that we use here, first of all, we start to look for assets that we are already bullish on. So for example, I am bullish on Bitcoin, so I'm going to select that over on CoinGecko. And then also scrolling down, I'm also bullish on Ethereum. So I'm going to go ahead and go to Metrics Finance. As you can see, metricsfinance.com. So I can naturally go over to Uniswap and find Bitcoin and Ethereum as a concentrated liquidity pool. So now we can naturally go over to Uniswap and find Bitcoin and Ethereum liquidity pools. And remember, in concentrated liquidity pools, we have to have two separate assets. So we can do something like wrapped Bitcoin to USDC or just wrapped Bitcoin paired with Ethereum. And then same thing with Ethereum. We can do Ethereum paired with wrapped Bitcoin or Ethereum paired with USDC, or you can just do some other asset paired with Ethereum. I'm going to go ahead and pair up Ethereum to USDC over on a software known as Metrics Finance. Metrics Finance is simply an analytical tool as well as a data tool. It's a software that really helps ease your journey in liquidity provision, as you're still going to be deploying into Uniswap over on Uniswap positions. And disclaimer, here at Builder Wealth, we are the founders of Metrics Finance. And over on Metrics Finance, for example, say we want to put our deposit amount as $10,000 right here. It's going to go ahead and load. And then now we're going to go down here and choose our min and max price. So for my min price, I'd personally be okay with doing around 2,153, and for max, I'd say for now around 3,190. I could tighten this if I want to, but I'm gonna leave it around here. And for min price, I'm actually gonna move this even more. And you're probably wondering why my min price is so close to going out of range. And I would choose this range in the sense that I'm betting on the upside for Ethereum. I personally think Ethereum is gonna go on a run. That is why I am setting the parameters up like this. So basically, by executing on this range, in Ethereum we have about 55%, in USDC we have about 46%. But it's almost half, but you can see we have more exposure in Ethereum than USDC. And the reason I want to do this is because in Ethereum to USDC, as the price goes up, I'm being sold into USDC. This is essentially a possible extra trade I can do with Ethereum to USDC and hopefully make some extra capital with this. So as you can see with these parameters, it's set to do 161.68% APR. And if I'm going to turn down the max price or make it tighter like this, we can see that the yearly APR goes up to 190%. And I'm pretty comfortable with having them set right here since I did say I am bullish on Ethereum. So let's just say, for example, I'm in range for 5 days here. And then also if Ethereum, let's just say, goes to the price of 3,000, we would end up with $10,570. So in 5 days, that would be almost $600 profit. So this is a pretty solid strategy, and essentially we're dollar cost averaging out of the Ethereum position as the price goes up. And then we're basically moving that into USDC, and of course we have the liquidity pool yield. Now, once it goes out of range, what exactly would we do? Well, guess what? We take that $10,570 profit that we just made right here, and I would throw that over into Ethereum and just hold that as Ethereum in my wallet since I'm bullish on it. I would exit the strategy, wait for a dip, and then enter again with my initial $10,000 investment. So we'd be keeping this 570 in Ethereum. So this strategy allows you to continuously accumulate Ethereum, as you can see. So the other thing we can do is run it on the opposite direction. We can run it on the downside. So let's just say we had a max price of 2,700, and then if we put the min price to about 2,000, and then I'm going to do 2,750 actually for this here. As you can see, now we are more projected on the downside. So let's scroll up and see what we have in each asset. So we have about 88% exposure to USDC and only about 11% to Ethereum. Well, what happens if Ethereum were to go down to 2,000 here? Well, look, we'd have a negative 12% loss. I'd have roughly $8,792 from that investment, but I will not just have this almost $9,000. I will also have 4.257 Ethereum, which, keep in mind, our starting Ethereum would be 0.42, so we'd be going up in the amount of Ethereum we have because this USDC is being used to buy Ethereum, which ultimately means that we'd be dollar cost averaging into Ethereum. And then as soon as we hit that bottom price of 2,000, we could exit out of the liquidity pool, and then we can put all the Ethereum into a brand new liquidity pool. So here's what that would look like. So we'd have roughly $8,792. So I'm going to take that number and plug it in right here, and then the current price would be $2,000. And then as the price starts to move back up, I would open up a brand new position. In this case, it would be an out of range position, like so. So maybe I have a range of 2,800 to 2,900 like this. I'm going to make that a bit wider. Let's see, like that. So let's just say we have a min price of 2,800 and 2,900 for the max price. So it's out of range, but when it is in range, of course, we will be collecting very high fees. And during that range of 2,800 to 2,900, that Ethereum will be sold into USDC. So this is just one of the many strategies we can execute with Ethereum in order to earn passive income. And Metrics Finance makes this really easy to simulate returns and possible strategies that you want to try out yourself. And of course, you could also execute these strategies with other currencies such as Link, Matic, or Wrapped Bitcoin, etc. You can execute these strategies with pretty much any asset that has a liquidity pool over on Uniswap. Also, I'm giving you guys access to a free trial of Metrics Finance, so go ahead and just click the link in the description down below. But now I want to talk about Ethereum to Wrapped Bitcoin. Now, Ethereum to Wrapped Bitcoin is probably not going to have a crazy high return. It's probably not going to have the almost 200% return we just saw on that past pool, but it is going to be more of a blue chip pool because both Wrapped Ethereum and Wrapped Bitcoin are correlated, and this would be more equivalent to hodling Wrapped Ethereum and Wrapped Bitcoin. So once again, let's set our deposit amount as $10,000, and then I'm going to scroll down, and for max price I'm going to set it to 25, and then for min price I'm going to set it to 21.5. So now I'm going to go ahead and click this little swap button right here. And if I were to go down and set my max price to about 25 and then my min price to 21.5, we have a graph looking like this. I'm actually going to leave more room for that min price, so I'm going to scroll down to about here. Let's say 20. Now I'm going to drag my max price even tighter, I think. I want to try to get as close as I can to equal exposure to Ethereum and Wrapped Bitcoin. Okay, perfect. Now we have it. So we have about 49% to Ethereum and then 51% to Wrapped Bitcoin. We're chilling like this. So there's a couple reasons for doing this. First of all, historically, Ethereum outperforms Bitcoin. But over the past 30 days, looking at this chart, it tells us that Bitcoin is outperforming Ethereum. And this is because we're looking at how many Ethereum equal 1 Bitcoin. So when it's taking more Ethereum to equal 1 Bitcoin, that means Ethereum is underperforming Bitcoin. So when we're using a range like this right here, where our min price is 20 and max price is 24, and we have this set to 50% Bitcoin and almost 50% Ethereum, we're basically taking on equal amounts of exposure to both coins. So that means that if Ethereum starts to perform well, we still have exposure to it. Or if we keep going in this trend where Bitcoin is doing really well to Ethereum, we still have exposure to it. So it says this strategy is currently doing about 55.7% APR. And this is because there's not a lot of liquidity at current prices and volume is sky high. As you can see, on the 5th, we had $15.8 million in volume. And at the 13th, it's at $8.69 million in volume, which is still a ton. But once again, so for example, if Ethereum were to go to like 3,000 and then Bitcoin were to go to something like 60,000, since Ethereum outperformed Bitcoin, you can see now we have all of our money in Bitcoin. But again, this can be way better than having your money in just USDC because USDC is not moving up in price. This is a really good strategy for a bull market, or if you're just looking to hodl, you can do the same thing but with wider ranges and not having to change your ranges as often. Just remember, you have to keep this in mind that when you go with a broader range like this, the yield is going to go down. See, if we make this wider, now it says has 41% APR. But for example, if Bitcoin were to go to, let's just say 65 or 66,000, you can see we still have some money in wrapped Ethereum. And this is because these assets are moving more in a correlated manner. So this is pretty cool. We still have exposure to Ethereum and still exposure to Bitcoin. So since Ethereum did do better than Bitcoin, we lost some exposure. But here, there's still a really small difference. And as you can see, there's only a very small difference right here. And the hope is that the fees would outweigh this small difference right here that we can see. So this right here is divergence loss, and divergence loss happens when two assets diverge from each other. So if Bitcoin is going up more than Ethereum, or Ethereum is going up more than Bitcoin, that creates divergence, which ultimately creates divergence loss. Remember, divergence loss is not final until you rebalance your position or exit out of it. And here at Builder Wealth, our strategy has always been find assets that you personally believe in. So that could be blue chip assets like Bitcoin, Ethereum, etc. And then take those assets over to Uniswap and then find high performing pools. And you can do this again using Metrics Finance. It makes it super simple, as you saw in this video. So for example, you can go to the Metrics Finance Discover page and see a ton of different pools and a ton of different information about them. And you can always simulate them and see your potential returns just like we did. And once we find our high performing pools that we want to deploy our capital into, we do that and just hodl and try to get the most return that we can. Well, think about it. If you're taking all that yield that you're earning and constantly compounding it back into the underlying asset, which means you're constantly building up a bag in those. So over the course of the year, say you earn 100% APR and you started with 1 Ethereum. Well, now you make that 2 Ethereum because you compounded all that Ethereum. And then maybe Ethereum goes 5x from there. But instead of going 5x, you'd go 10x because you started with 1 Ethereum. But you accumulated an additional one through the liquidity mining on Uniswap. And then now it went 5x, so it means that your 2 Ethereum that you had is now 5x. But on your initial 1 Ethereum investment that you had, it's now gone 10x. So that's the beauty of concentrated liquidity pools. You can really design your own strategies however you want to. Guys, I went ahead and put together a free guide teaching you exactly what liquidity mining is, and I'm going to put that in the description down below. All you got to do is enter your email and you can access it. It tells you a bit more about myself and also how you can get started in liquidity mining. Anyways, make sure to subscribe and stay tuned for more.